So just as there's success in the market, there's also a lot of failure in the market. The indices, the S&P 500, the Dow, are actually indices of success. There's survivor bias just in those indices. Over time, companies fail and go out of those indices and are never heard from again. And certainly that's true of the broader market. Many companies come public, they grow, and they fail. Some rather spectacularly, some rather quickly. As I talked about with the IPOs, a fifth of IPOs are gone within 5 years. That's a high failure rate. Young companies don't always succeed. Markets don't always go up, they go down. We've seen that particularly in the past 10, 15 years with big bear markets. And we think there's value to be added from understanding what are the characteristics of failure and being positioned for that. So we do most of our hedging through put options, actually. We've learned over the years that for us, put options are an attractive way to hedge because you can know your loss going in. You have a maximum capped loss. It's really just the premium that you're paying for the put. The other thing is I think it simplifies the psychology around running a short portfolio, because if you short to hedge, when you're wrong, the position becomes bigger in your portfolio, it runs against you, and if it acquires significant momentum, it can actually run you over. And but the problem is, psychologically, for many short sellers, is that as a stock goes up, in theory, it becomes more attractive. So it becomes difficult for an investor to downsize a position just as it's becoming more attractive. That's very different with, it's the opposite of a long. When a long doesn't work, it becomes smaller and has a smaller impact on your portfolio, and you're thinking, should I add to it? When it becomes big, it's becoming a bigger part of your portfolio, which you might be exiting and feathering out. But a short, it's a perverse kind of mechanic of portfolio management. The other side of shorting is that as it works, it becomes a less and less effect on your portfolio. So in theory, you need to be adding to a company as it's going down, as it's also becoming less attractive to short. I think puts simplify a lot of that psychology and portfolio management, because it amplifies on the way down. It sort of does it for you, adding to the position as the company's falling apart. And it protects you as the company's rising against you, allows you to calmly reassess and reset. The negatives of put buying, though, of course, is you have a finite amount of time for your thesis to be right. It's like buying insurance. If you don't have a loss within the period of the insurance, it has no value. So you have to keep buying insurance into the future. And the other is volatility in the market generally. As volatility in the market goes up, put options become more expensive and therefore less attractive as a form of hedging. So when volatility is low, like it's been in recent past, we tend to do much more of our hedging through puts, and when it's higher, we tend to migrate back more to the short side. So that's the portfolio management side of hedging. The other side of it is what do you short? What's the security selection aspect of it? And our favorite areas are poor business models, unproven business models. Another big area is capital structure problems, where a business has got a lot of debt, or is burning money, or has an event occurring, and it's an inevitable event that's going to occur in its capital structure where it has to raise capital and dilute equity holders. That's another attractive area. And then finally, it's the kind of fads and frauds area. These are more sporadic, one-off kind of things that you find. Fad products. One of ours from a couple years past was the Crocs, the shoes that it grew to a point where they were going to need to be selling 100 million of these shoes in perpetuity, and things like that you could see were impossible. And then the frauds are things that are much more difficult to discover. It's much more you just serendipitously stumble upon it. It could be an accounting issue. It could be some contract problem as you dig deep into the filings and read things.